to another weekly episode. Do follow me on Instagram. My ID is st_pyi, just in case you need to discuss something that you cannot write in the comment section. And keep your notifications on because in general, the platform will never recommend buy videos because there is no clickbait content here. So today's video is about distinguishing between a genuine bull market rally versus a bear market rally, which turns out to be a trap for majority of investors and traders. Again, I'll just first cover the basics of what a bear market rally is, and then I'll give you some key points so that you can distinguish between a bear market rally and a genuine bull market that is about to follow. So first, we'll begin by understanding what is a bear market rally. See, within a bear market, there are many counter trend rallies that are pretty sharp, and they almost always tell the investors and traders that the final reversal has played out in the market. But you got to be careful because a bear market rally can be a serious trap, especially for those who blindly chase momentum in the short term. So bear market rally typically is a dead cat bounce. Now, what does it mean? It is often referred to as dead cat bounce, a temporary reversal of a declining market trend during a broader bear market move that is playing out. What are the typical characteristics of this? There is a sudden reversal in the market. You often start to feel that a new trend has begun. Typically, you will see the sectors that have been beaten down a lot. Those are the sectors that start rallying the first. That is actually a big sign that it's actually a bear market rally and not a genuine bull market upcycle that has begun. And the third is it often gives you an illusion of misplaced optimism. See, investors and traders will often mistake these short-term rallies for long-term recoveries. And that actually leads to a lot of misplaced optimism because you'll quickly see people bringing in a lot of money, then finally getting trapped at higher levels, and then eventually the price will start moving lower. And that actually fuels the next leg of bear market. In case a bear market rally is going on, a lot of investors start bringing in a lot of money due to FOMO, that is fear of missing out. And when they see price again starting to reverse, these are the people who start selling a lot. Plus, there are previous people who are selling a lot. That actually accentuates the fall in bear market, and that eventually leads to capitulation in bear market. So this is one of the major reasons that you got to be really careful and not commit a lot of money when you see price starting to move from the bottom level, because it takes time, and it will take you time to understand whether this is a bear market rally or a genuine bull market at play. If you look at some historical examples, this is 2002, the US bear market, when the prices began to correct. Look at the counter trend rally that developed. It was 41% from the bottom. Again, it was 30% between November and January. Again, 43.8% here. And the last bit of counter trend movement was about 50%. So price kept falling. The peak here was 4,200. Eventually, the price bottomed at 1,400. This is NASDAQ 100 index. So you got to be careful. Again, one more example is that of 2008. Within 2008, there are two times you saw a near 20%, 15%, and 30% retracement. And then eventually the market made a new bottom and it eventually bottomed out, and then the 2009 bull market started. So it is not that from the bottom, if the price rallies about 20 odd percent or 25%, it cannot roll over and move down again. You got to be careful here. You have to look out for subtle signs within the market in terms of leadership, in terms of volume, in terms of market breadth. This is something we'll discuss as the video progresses. So now we'll come to the key guidelines as to what is the difference between a bear market rally and a genuine recovery that happens in the market. First, the bear market rally. The major hint that you'll get is leadership is absent. So typically bear market rallies are short-term, characterized by a lot of volatility, often driven by short covering or speculative buying, and usually lacks a lot of fundamental support. That is economic data points, monetary policy. These things are not aligned whenever a bear market is going on. I'll come to my verdict towards the end of the video. Now, what about genuine recovery in the market? See, you always find signs of clear leadership whenever a genuine bottom process is going on. So genuine recovery will often show upward momentum in terms of price action. It will be backed by improving economic fundamentals, increasing investor confidence. This is something you will only know over the next 2-3 months. And broader market participation. What does this mean? This is the market breadth. And this is the key factor out here. You have to see whether the rise in the market is on back of rising volume. And whatever breakout is happening above resistance level, whether those breakouts are sustaining or not. And which sectors are breaking out first? When the bear market is going on, which sectors are resisting that fall? Are these the sectors that break out whenever the market starts to recover? Because if that is the case, then that becomes a huge hint when you compare a bear market rally versus a genuine recovery. If you look at what is happening in the market today, in the last 2-3 videos, if you haven't seen the videos, you will not understand what is being discussed. I'll link the previous videos out here. In the last 2-3 videos, I've been telling you that based on fundamentals, based on whatever is happening in India in terms of economy, lower inflation, growth oriented monetary policy, stimulus by RBI. These are economic events that are lining up in the market. And now you're seeing some recovery happening. When the bear market was going on, which sectors were trying to resist? Banks, finance, chemicals, fertilizers, metals, financial services. These sectors were resisting the fall. And which sectors have started moving up first? The answer is very clear. So we are somewhere in the genuine recovery phase, as per my understanding. It is just that it is going to be a different kind of recovery that I'll showcase in the last slide of the video. Now, before I move forward, I will also have to tell you some common traps that you have to avoid during these phases. The first is sudden and sharp price increases. If you look at the weekly candle that is formed in the market, we have had amazing recovery from lower levels. You have to understand that sometimes there is rapid price movement that happens without fundamental backing, especially in stocks. There are a lot of stocks in the SME segment also that have recovered a lot. Significant recovery has happened. Be careful in this segment still. I don't think a massive reversal is still coming in the newly listed IPO names or the SME segment. Misinterpretation of economic data. In our case, if this recovery is genuine, I think market is interpreting the economic data correctly. But what if I were in the US today? If I were in the US, the recent Fed commentary that has come out in the market is not aligning with the economic data. If I were the Fed chair, I would certainly warn the market in terms of sounding too hawkish about a sticky inflation that can play out in the US market, especially the government policy that the government is promising currently. So you have to be careful. Especially if I were in the US, I would be very careful because economic policy, monetary policy, and what the government is doing is currently not aligning. Third, the media and sentiment influence. This is a big trap in these times. See, media narratives can exaggerate positive signals and influence investors' psychology. The point I want to make is look how the narrative has changed in the last 1 week. A week back, if you read the headlines or look at a lot of YouTube videos, the videos were about 20 to 30% more correction in the market. And how about today? You're only seeing positive commentary. You're only seeing headlines about why this recovery can be genuine, why investors should have bought the dip. This is what messes up your mind. This is what messes up your psychology and throws you off your game plan. That is why I always insist you don't need a lot of content to understand what is happening in the market. Study the market 45-60 minutes every weekend and leave everything aside. It's absolutely critical that you do this. Else, this short-term gratification kind of thing that you're going through, you will never come out of it. And you'll always end up blaming the market when you take losses. The last is about chasing momentum. You should never chase pockets of stocks that were beaten down the most. If some of the pockets that were beaten down the most from October to March are rallying the most, stay away from those names. Stay away from those names because they may not be backed by fundamentals. Number two, there are a lot of people who are stuck in those stocks and segments who would want to exit. And number three, there are no structures in those pockets. There are all V-shaped recovery on charts, and those V-shaped structures are very dangerous to trade. Move forward, I'll discuss two major points in detail that are a big red flag when it comes to bear market rally. This will also help you identify any potential bear market rally that is going on versus genuine recovery. The first is volume analysis. See, bear market rallies often occur with lower trading volume when compared to genuine recoveries. Volumes have to pick up. Without volumes, price will roll over. This is especially true after correction. It takes a lot of buying for stocks and index to move up. If you look at the Nifty 500 index, and before the video, if it goes out to editing, if I get the data, I'll put up the chart in front of you. If you look at the Nifty 500 index over the last 3-4 days especially, there is volume coming back in the market. That is a good sign. I'll see if I can arrange that chart for you. Else I'd put it on my Instagram handle. The next is technical indicator. Today you are seeing price is above 50 DMA but below 200 DMA. So watch this closely. Quite often in a bear market rally, price starts taking resistance around the 200-day moving average. If the rally is genuine, then you will see something like Nifty 500, price will start sustaining above 50 DMA and then eventually it will make an attempt to take out 200 DMA. Then over a period of time, 50 DMA goes above 200 DMA, which is also called the golden cross. The next is sectors moving. I just covered this point, but I want to expand a bit. Which sectors are moving up? Are these the same sectors that were beaten down in the bear market? If these sectors are the ones that are moving up and taking the market higher, then more than likely it is a bear market rally. On the other hand, if you see banks, finance, metals, financial services, chemicals and fertilizers and hotel space, sustaining above 50 DMA, absorbing supply, and then breaking out again, that will be a huge clue as to this being a genuine move in the market. Again, these are all clues. If you're looking for a straightforward answer, then stock market is not for you. Stock market is a puzzle that you have to solve every week and look at the probabilities ahead. The last is market breadth. How many stocks within Nifty 500 are moving towards a higher high, higher low structure? I'll explain this chart in a bit. Are these stocks able to cross and sustain above the previous major pivot levels, which actually signals a shift from lower high, lower low to higher high, higher low? All right. So the current market breadth data, what is it suggesting? Here I have the 50 DMA, this is 200 DMA, this is number of stocks that are in higher high, higher low structure. The reading is 12, which means there are 12% stocks within Nifty 500 which are in a higher high, higher low structure. When it comes to 200 DMA, currently 15% stocks are only above 200 DMA. And when it comes to 50 DMA, about 36% stocks currently are above 50 DMA. This number has improved drastically, but this number is still not in a bull market territory. Same with 200 DMA. 200 DMA, currently 15% stocks are below 200 DMA. This actually tells you the kind of damage that has happened in the market. This also tells you that market will give you a lot of opportunities to build positions if this is a true genuine rally. Many people commit the mistake of bringing in a lot of money as soon as you see a 3, 4, 5-day rally. That is a big mistake. You have to space out your bets. This is a message I've been giving you since the correction began in the market. Higher high, higher low. Just 12% stocks in Nifty 500 are in higher high, higher low structure. For a bull market, at least 50% or more is needed. Why? Because that brings sustainability of trend in the market, and that is where you make money. Now, what is this higher high, higher low structure? Can you look at this recovery that has happened? This is one pivot, this is one more major pivot, and this is the all-time high major pivot. If you look at it, market has not even crossed this particular pivot here. When it crosses, then you will have to assess its strength. This can just be one of these recoveries or these sharper recoveries that played out in the market. Remember the structure here? This structure is high, 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 another high, another high. So this is higher high structure. Lower, that is higher low structure. What is the structure today? It is lower high and lower low. Got to be patient. Be optimistic, but be patient when it comes to committing a lot of money. You have to sip this structure. You have to gradually allocate money and assess the conditions as opposed to committing everything and then one more reversal plays out and that ends up in a disaster. Now give out some practical tips to you in this particular phase and then I'll give you my verdict as to what I think is happening. The first is stick to the rules. In the last 3-4 videos, I've given you clear rules about technicals and fundamentals that you have to follow. So it is very important for you to set clear rules, that is for investment and trading, and then stick to it. Avoid buying during rapid short-term spikes without structure confirmation. What is structure confirmation? No VCP, that is volatility contraction pattern. No cup and handle, no flag breakout, just a simple V-shaped movement on the upside. Usually such V-shaped movements don't lead to a good kind of return in the future. Next comes risk management. Again, if you want to buy something, have clear stop loss levels. Your position sizing has to be proper in terms of amount of risk you can take in the market. If you blindly go ahead and allocate a lot of money and then the market starts to reverse, there's only one person you have to blame, and that is you yourself. Remember, this is not the phase where you bet a lot. This is a phase where you do a lot of homework, analyze a lot of sectors, start nibbling a bit. And then as market confirms structure, start scaling in your position. A bull market won't begin today and end tomorrow. A bull market, if it has begun in March 2025, will at least last for the next 12 to 18 months. You will have your opportunities to scale in, to buy new names, and then to eventually hold on to your positions. The third is solid business. I've actually done 2-3 last dedicated videos on this. The importance of patience and waiting for confirmation through sustained fundamental improvements and technical strength is the need of the R and bear market. If you think you can go and buy those SME names again with no sales, no revenues, high debt, then good luck, because that is going to result in massive losses going ahead. The liquidity tap currently is somewhere between the off and maybe a 20%, 25% liquidity on kind of mode. It's not fully switched on. When the liquidity tap is fully switched on, that is when these SMEs, the new IPO stocks do well. But when the liquidity is scarce, and which it is, and it is going to remain this way because of how US economics is shaping up, you have to be buying only solid businesses. All right, the phase of 2020 to 24 is over. This is a new phase we have entered. You have to make adjustments. So, what am I buying? Ever since the correction has started, I've emphasized on homework. I've emphasized on identifying every week where is leadership, which sectors have strong relative strength, which stocks within these sectors have fallen the least, why you should be building a test portfolio. This is important. I've repeated this so many times. Whenever the market was falling, I was buying few stocks, building a test portfolio. Why? Because when such V-shaped recoveries happen, that is when people rush to buy stocks and allocate money to sectors. You have to start buying and doing your homework when the market is correcting sharply. Don't allocate a lot of money. Allocate at least 10%, 15% and see what happens, because that 10, 15% is going to give you a huge clue as to whether this is a genuine rally or just a bear market trap that everybody is going to get stuck into. And importance of being focused during market fall. Again, this is a point I've repeated so many times. Don't go behind pennies when the market is offering you dollars. Short selling is of limited use. Short selling, writing options, this is a huge trap that many entities have designed for you, and you have to escape this. Equities is the best asset class. Even when markets are falling, you have to do your homework, select the best stocks and keep them aside. And when the market stabilizes, then you have to go behind these names. So now I'll come to what I think is going to happen. Again, this is not a new chart. This is something I've shared in the start of 25, a couple of weeks back also, and this chart remains the same. So what I had told you that somewhere in this quarter, we'll begin a rally in the market. Currently, we have seen a V-shaped recovery. I don't know whether that is a rally or not. I don't know because I don't have a crystal ball for it. But I think the next few months, maybe till June, maybe till July, again, these things I don't know, the market will be heading up with random volatile movements in between. And then we are going to go back and retest maybe this low or the 50% of this move. This is going to happen in the remainder of the year. And then in 2026, I see a really strong rally in the market. The reason I'm still sticking with such kind of structure is because I don't know how the US market is going to shape up. See, if the US market will simply underperform and gradually move lower, I think India will do very well. But if the US market, based on whatever the government is saying in terms of policy implementation, in terms of cutting taxes, if that is what is coming, then that is going to be inflationary in nature, which means at some point in time, Fed will come in, warn the market about being hawkish, or maybe they will pause the interest rates, or maybe raise it also a little. Too many global investors and traders have become used to Fed bringing the interest rates to near 0% level and keeping it there. Last 15, 20 years, that is what we have seen post the 2008 financial crisis. But if you study historical data, there have been precedents where Fed has maintained interest rate between 2.5%, 3% to even as high as 4.5%, 5%. If we are heading into that kind of era, then there is no way that we will have a really smooth kind of uptrend in any stock market in the world. We'll keep having a lot of fluctuation. This is why, while I'm bullish on India for the next 5-10 years, I don't know about the trajectory. I don't know about the trajectory, and I want to be consistent, because when the market will start correcting tomorrow, I don't want to come and sound the alarm that this was bound to happen. My stand is same. I am bullish on India, whether it was in December 24, whether it is today. But the trajectory is something that can only be anticipated as and when market forms structure based on economic events that play out. That is the reality we are in today. Large caps and mid to large caps in our market will outperform the small cap space, the IPO space, and the SME space. Because, as I explained earlier, whenever the liquidity is scarce, it is the good businesses that do well. So, whichever stocks and sectors are taking the market higher, maybe we'll stop here, maybe start reversing from Monday, I don't know. But one retest of this midpoint will happen. Whether it happens in June, July, or September, October, again, I don't know that. And I have to be honest here because I don't have a crystal ball. But whichever stocks and sectors are going to take the market higher, they are not going to come back and revisit these lows. It's actually the weaker sectors that will revisit the lows and will drag the market lower. But this retracement, the strong pockets that existed here, will give you an opportunity to add to those names. And then probably the market will again rally. I'll keep sharing this chart because obviously it's a developing kind of scenario. And I, again, don't have a crystal ball to see all this. It's obviously an educated guess based on where we are in terms of valuations, where we are in terms of monetary policy, economic policy, which I feel is just amazing currently in India. I can't think of a period in the last 20, 25 years where the monetary policy, fiscal policy, and what the government is doing has aligned so perfectly for us. Yes, we have had a fantastic bull run 2020, 2024, but this bearish cycle that currently is going on will be short lived. Whether we bottom out in September eventually or March 2026, that is anybody's call. But I'm pretty sure that the trend that started in March 2020 will go on for at least 12 to 15 years, at least till 2030, 2033. That is the kind of bullish cycles that typically develop when major economic changes happen in a country. Whether you study the US data from 1970 to 2000, whether you study the European market data, that is what the data suggests, that when such events happen in an economy like it has happened in ours, there are a lot of reforms that have happened. Those reforms don't go away so soon, and the positive impact of those reforms actually stay for many decades. So that is my call. Let's see how it plays out. I hope today's video was helpful to you in terms of identifying whether we are in a bull market recovery or a bearish trap phase. So do let me know if you have any doubts. I'll answer it today. Make sure your comments come in today, that is on Saturday. So take care, guys. Be safe and have a great weekend ahead.